All right, today we're looking at costing and payroll questions. We're going to begin with Elizzy. Elizzy is the owner of the wedding cake maker. She uses absorption costing to price her products. Elizzy has provided the following information on cost. Place a check mark in the relevant column of the table to indicate whether the cost items are direct or indirect production costs. So direct production costs are those that can be traced directly to whatever is being produced or made. So in this case, we're talking about costs that could be traced directly to a cake, the making of a cake. So salary of the cake decorator will be considered to be a direct cost because we could trace that directly to the cake that is being made. Rent for the factory, however, will be indirect. Machine depreciation, right? This is one that will be indirect as well too because we can't trace it to the making of each cake. But the cost of raw materials used to make the customized cake will be considered a direct cost. So direct costs could be traced directly to the making of an item. You will know how much of it is involved in that production, right? Indirect costs are those that are not directly traceable to the item, the unit being produced. The following details are available about indirect costs for the decorations department. So there's the allotted costs and there's the apportioned costs. Allotted costs are those that are could be easily, I don't want to use the word allotted, but assigned to the decoration department. Apportioned costs are those that are shared amongst many different departments. So this could be things like electricity, rent, right? So we have to apportion it to the different departments. Yeah? Right. So they say to calculate the total indirect costs for the decoration department showing all working. So this will just be a summation of the two. It will be an allocated cost, which is $17,000, plus your apportion costs. That will give us the total of all the indirect costs associated with our decorations department. Right? This will sum up to $20,000. The following details are also available about the production hours spent for labor and machinery in the decorations department cost center. So machine hours seems to be the dominating factor here, with 400 hours being spent on in terms of machine hours in the decoration department, and direct labor hours are 100. So the dominant factor in the decorations department based on this information is clearly machine hours. Now, why is this information important? The other part of the question here is going to answer that for us now. They say using information from A2. A2 is this total indirect cost that we calculated, our overheads, and B1 being the dominant factor in the decorations department. We want to calculate an absorption rate for applying the overhead cost in the decoration department. So to calculate this absorption rate, we're going to take our total indirect costs or total overheads and divide it by our machine hours, total machine hours. So that was 20,000 divided by 400. And now we can out to be what, like $50 an hour? Yep. So we say it's $50 per machine hour. Now what they're trying to do here, just to kind of give you a little background of what's the point of doing this. When we have to cost a job, and you'll see it later on in the question, we need to assign the indirect cost to that particular job, right? So we're going to use this rate in order to assign the overheads associated with that department to a particular job. Let's look at the other part. In December 2022, Ellerslie received an order for a customized wedding cake and incurred the following costs in its production. Now look at these costs. They are the direct costs that can be traced to the making of the wedding cake. Here we have the direct material costs. We have the direct labor costs. But here we have the total amount of machine hours spent making this cake. Use the absorption rate calculated in B2 to work out the indirect overhead costs for this order. So now what we're going to be doing is we're going to take the total hours spent, the total machine hours spent, and multiply it by that rate that we calculated earlier on. How much is that? 1,000? 20 by 50, yeah? $1,000. So for this particular wedding cake, we have assigned, or we could say that we have a portion that has absorbed $1,000 worth of our indirect overhead costs. Yeah? Now, in the space provided below, calculate the total production cost of the order. So the direct materials total cost was $450. The total labor cost was $1,250. And the total indirect cost associated with this order was 1,000. So 1,000 plus 1,250 plus 450, 2,700. So this is how we come up with the total production cost for a job. Right now, we find this type of costing very applicable in situations like this, where you have unique products being made. A cake is a unique product. Each one would vary. It will require a certain amount of materials, a certain labor cost, a certain number of machine hours, as described here in the question. So we have to work out what our cost is for making this cake. After doing that, it allows us to do this. The wedding cake maker has a markup policy of 50%, right? A lot of people in this type of business would usually calculate their cost like this, work out what the cost of producing the cake is, and then they will have a markup policy. If it's twice times their cost, 50% markup, and this allows them to calculate their selling price. So the selling price for this wedding cake order, the special order, will be $2,700 multiplied by 150% because you're marking it up by 50, right? So we're doing 2,700 by 1.5. So the total selling price for this cake will be $4,050. Right? This is all working here. This is the selling price. Esther, the head cake maker, is given the job of making the customized wedding cake. It is the company's policy to pay its workers using the piece rate system. List one advantage of the piece rate system as a method of payment. Now, the piece rate system is a system whereby we pay workers based on the amount of units that they complete, right? The benefit of doing that is that it encourages productivity. Yes, because the more units they complete, the more they're able to earn. So you could see here it encourages productivity as workers are paid for number of jobs or work items completed. Now, I mean, they more than likely would have a base salary, right? But the piece system is it's be like additional. So in order to make more, they could work more, be more productive. Here we have this other question. Define the term statutory deduction, right? Statutory deduction. This is a portion of a worker's salary that employers are required to withhold by law to submit to the government as taxes, national insurance, NIS, and health surcharge. Right? This is how the government raises their tax revenue by pay as you earn or income tax, right? NIS deductions for being able to provide pensions and other benefits and health surcharge, right? So a statutory deduction is a deduction that is required legally by law. Employers must withhold a portion of the worker's salary. This is usually stipulated by the government, Board of Inland Revenue, and National Insurance Board, and places like this. All right, so here's another question. We have James Bolo is a machine operator at Zimbo Construction Company. The following is Mr. Bolo's information for the year ended 31st of December 2021. So he has his annual salary, personal allowance, income tax rate, national insurance, right? So you see the rates I was talking about, pension plan contributions, contribution to health surcharge, contribution to savings scheme. Calculate James Bob's taxable pay for the year ended 31st of December 2021. So his taxable income, I'm going to do it on the side end. Will be the annual salary minus the personal allowance. Right? The personal allowance is an amount which cannot be taxed. So we first need to subtract that from the annual salary to determine what the taxable income is. Right? So you only pay tax on taxable income. So 80 minus 18,000, we're talking about $62,000 is his taxable income. Right? And you see in bold say show working clearly, right? So don't just plug this into a calculator and write the answer here. You want to write a little statement like what I did on the side here. Show the two figures, subtract, get your final answer, and identify it as the taxable income. Calculate Bolo's net pay for the year ended 31st of December 2021, showing all working clearly. So, to begin with, let's start with his gross. Everything here is for the year, right? So, gross income. I want to show all the working. So, we're starting from the top. So, we're going with $80,000 less personal allowance, which was 18,000. Right? Let's leave this. Say that's $62,000. Right. So you're coming on the road now. So he has income tax. And that's at a rate of 20% by the taxable income, which is 62,000. That's $12,400. Then we do a national insurance. Now we have to pay attention to what is written for the rates of these, right? Because they're saying 5%, but not 5% of the taxable income. They said 5% of the gross pay. So here we're doing 5% of $80,000. That's 4,000. Pension plan. They say 4% after income tax. So some of these you might have to work out some figures in between, right? So for example, the after income tax, so 80,000, this is total salary. We take away income tax, which is 12,400. The remaining is that minus this personal allowance. $80,000 minus 12,400. 67,600. Multiplied by 4%. Now, for the pension plan, I want you to understand the calculation, right? So his annual pay is 80,000 minus, they say after income tax. So I'm taking out the income tax, which was 12,400. That will give me a figure 67,600. This is what I find in the 4% of. Right? This is what gives me the 2704. Now, when we find the income tax, we could only tax this 62,000, not the 80,000. Understand? The national insurance is 5% of your $80,000. So national insurance was 5% of 80,000. That's why I give them the $4,000. So you see these figures that they're using here, right here, these are important, right? When you're doing the tax, I'm going to show you the tax here too. We're doing 62,000. 20% multiplied by 62,000. So you have to make sure you have the correct figures that you find the percentages of. Yeah? The last two, your health scheme, contribution to health scheme, and contribution to savings scheme is easy because they give us the figures there. Just abbreviating that.
So is this still manufacturing?
No, this is a payroll question. Right? We're calculating the net pay for James Bolo. Right? So net pay. 62,000 minus 12,400 minus 4,000 minus 2704 minus 600 minus 1,000. So the net pay here is 41,296. And this is Bolo's net pay. All right, so you're going to look at another question, Pet Plus. Pet Plus prepares weekly payrolls for 2 employees hired on the following terms. We have a sales attendant and we have a cashier. Right? The normal rate of pay for the sales attendant is per hour, hourly pay, and the cashier is by the day. Normal hours for the sales attendant, 40 hours, for the cashier, 5 days. Right? The time that the sales attendant actually worked was 45 hours. So that is telling me that there's an element of overtime. 5 hours of overtime work by the sales attendants. The cashier worked on normal time, 5 days. List 2 basic source documents when using payrolls. So when we're doing payrolls, there are timesheets, right? That's one source document. We could have clock cards. That's another source document. We could have, so in Trinidad, we have what we call TD1 forms or tax deduction forms, which are used to calculate the tax that the employee is supposed to pay, right? And we could also have something else called transfer authorization forms. Sometimes the employee may want the employer to take money directly out of their salary and send it probably to a credit union or savings account or a pension account. These have to be signed by the employee giving consent to do that, right? So these are 4. Could even add another one. Sometimes there's a payroll register as well too, for like the cashier, daily paid and monthly paid people, which basically gonna look something similar to what we have to do here, payroll sheet, right? Payroll register, payroll sheet. The first 4 are some commonly found documents for preparing payrolls. Distinguish between voluntary deductions and statutory deductions. So we briefly talked about before voluntary deductions. These could be things like, transfers to like a credit union account, insurance premiums, savings, transfer to savings account, pension schemes. These are deductions or deduction requests. Employees voluntarily accept or request, whereas statutory deductions these are mandatory deductions, must be done. And they are required by law. This includes things like income tax, NIS, and health surcharge. Yeah? Complete PETS Plus payroll sheet provided as an insert for the week ended 26th of April 2014, considering the following information. Overtime is 1.5 the normal rate. So the sales attendant who has a rate at $10, the overtime rate will be 1.5, which is $15 per hour. Social Security, which is a tax deductible. So this is an example of a statutory deduction. So it's the pension fund. It's 5% and 1%. Income tax is 10%. Right? So this is coming out of their gross pay. So they have a payroll sheet. The payroll sheet is done in a way that it makes it easy for us to calculate these things. So the pay rate for the sales attendant, we're getting that from the table above, is $10 per hour. For the cashier is $120 per day. Normal hours, 40 hours, 5 days. Overtime hours, we had 5 hours of overtime for the cashier. Remember, we saw 5 up on top. Remember this? So it's good to make notes. As you're doing these questions and you see these things that stand out, you make notes of it, or you put a star asterisk on it one time. So later on in the question, you have it there. So normal pay, we're going to work these things out now. 10 by 40 is, this is dollars. If you see here, these are dollars now. That's 400. Cashier, 120 days, $120 per day by 5 days. How much is that? 600. Right? Overtime pay, nothing happening here. Right? Total. So you're adding as you're coming down like this too, right? Overtime pay is going to be, remember, it's $15 overtime. So 5 by 15 is $75. So total gross pay now is $575. Here's 600. So you're adding across and coming down, right? $10.75. Social Security now. So Social Security is 5%. Right? So we find in 5% of the gross pay. 475 by 0.05. That's 2375. So you're going to get some figures like this, right? And then 600 by 0.05, 30. 23.75 plus 30, 53.75. Pension fund, 1%. So you find 1% of your gross pay, $4.75. $6. 10.75. Income tax, taxable income. They didn't say anything about any tax allowances. I'm not seeing anything about any tax allowances. So I'm going to say here that the taxable income is equal 475 and equal 600. Income tax is 10%. So 47.50 and $60. Total deduction. So you had to add up all of these deductions from here, here, and here. 23.75 plus 4.75 plus 47.5. 76 is my total deductions. And 30 plus 6 plus 60. 96 is my total deductions. 47.50 plus the 60, and then add this. Four 75 minus 76. 399 and 600 minus 96. 504. 903. Right? And this is what the payroll sheet for the weekend, the 26th of April 2014, would look like for Pets Plus payroll. Yeah? All right, so we're looking at another question. Ariana, manufacturing a component which is used in the production of cell phones. Sales of the component for each of the first 3 quarters of 2023 are forecast as follows. We have during the month of January to March, they anticipate that they're going to sell 5,100 units. Between the next quarter, April to June, 6,300 units. And between July to September, 6,760 units. These are units, right? Important point to note here is that she has been operating with a policy where she maintains her closing inventory. Her closing inventory is sufficient to cover 5% of the next quarter's sales. The closing inventory. So Ariana's forecast that sales in the last quarter will be 8,880 units. That's another important piece of information. Now, on the side here, I wrote the format for the production budget, right? Now, always remember that the production budget has to do with number of units being produced. Now, think about it. If we have our forecast for the amount of sales that we want to achieve or we aim to achieve in a particular period, we need to make sure that we produce enough units to meet those demands. But it's not just that simple, because we need to take into consideration that we may have some stock on hand from the last period that wasn't sold. And then at the end of the period, we may have some stock that will remain. So we need to take this into consideration so that we are not overproducing or underproducing. And this is where the production budget comes into play. Now, the word budget is like a forecast. You are trying to plan for the future, right? Now, this might be our budgeted production, and maybe in the real world, right, actual production might be a bit different later on. But it makes sense that you budget, you plan ahead in terms of how much units you need to prepare. This is important because the company will then use this information to make other decisions in terms of the amount of raw materials that they might need to purchase, right? The times in which it is they need to have these things delivered, right? How they plan to store these items. It influences a number of other decisions, right? So in preparing the production budget, we usually start with our sales figure. Right, so we could write in the sales figure, or this is budgeted sales. So we anticipate in this quarter to sell 5,100 units, 6,300 units, and 6,760 units. Now, the format that I've listed is a very simple format. Sales minus your opening inventory plus your closing inventory will give you a production in units. And this is essentially what we're going to use here. So next here, we're going to have less our opening inventory. Now, there's a relationship between opening and closing inventory, one that sometimes is so simple we don't realize. The opening inventory, right, was last period's closing inventory. Opening and closing is just 24 hours apart. Our accounting period runs from Jan 1st to December 31st. The closing inventory on the 31st of December is the opening inventory on the 1st of January. It's just 24 hours separating the two of them. So if I need to work out what the opening inventory is for this first quarter, that's why it's important for me to think about, right, what happened previously. Yeah? So they say that the closing inventory must be sufficient to cover 5% of the next quarter's sale. So this quarter sale of $5,100, it meant that they would have known that last year, in the last period, and their opening inventory, the opening inventory now is actually the closing inventory from last period, which is 5% of 5,100. Which is 255. Yeah? Everybody understand that? So we're going to complete this entire section here. Right? Now, that's that. Let's subtract those two. 5,100 minus 255. As 4,845. Yeah? Now, my closing inventory, we add in closing inventory now. must be 5% of the next quarter's sale. So my closing inventory for here is going to be 5% of the 6,300. Follow? So 6,300 multiplied by 0.05, we're going to get 315. So 4,845 plus 315 is 4,530. This is going to tell me my production that I need to do in terms of number of units. Let's see if we can make some sense out of this. We want to sell 5,100. We had 255 units from last period. So out of this 5,100, I already have 255, right? So that's 485 that are supposedly have to produce. But they say that they have a rule that they must always have 5% of the next quarter sale. That's so that you don't end up in a situation where you sell out everything and then next quarter you have orders for sales and you can't fill them because you have nothing in your closing inventory. You sell out everything. So you're always keeping a particular stock inventory level, which is 5% of your next quarter sale. So although we know we need to produce 4,845 to meet this, we want additional 5% of the following quarter sale in stock. So we are producing 4,845 plus 315. So we are producing 4,530 units. That's going to cover enough to meet our demand of 5,100 units and have 5% of the next quarter sale available. Now look at this, right? The closing inventory from this quarter then becomes the opening inventory for the next quarter. Remember I was saying it's just 24 hours separating these two things. So I want to sell 6,300 and I already have 315 on hand. So 6,300 minus 315 means that I need to make 59.85. Right? But remember, we want to always have 5% of the following quarter sale available. So the following quarter, we want to sell 67.60. So I'm finding 5% of that. That's 338. So I'm not only making this, I'm making this plus 338. So my total production in units is going to be 6,323, 6,323. And then my closing inventory from this period becomes my opening inventory for this period. In July, September, we want to sell 6,760. We already have 338. So we supposedly have to manufacture 6,422. But the next quarter, we want to do 8,880 units. So we need to make sure and have 5% of that set aside. And 5% of that is 444. So my total production is going to be 6,866. Yeah? And this is my production in units. That's our production budget. Right, let's look at the other part of the question. The selling price per unit during the budget period will be $8 per unit. How many units should Ariana plan to sell if she wishes to achieve a sales revenue target of 45,000 in a quarter? So, budgeted sales and this is in units. If we have our target and a selling price per unit, $45,000 divided by $8 per unit. Talking about 5,625 units. So she wants to hit her sales revenue target of 45,000. This is the number of units that she needs to sell. Now, look at how this question combines both the costing and then look, they bring in a little bit of payroll in it one time. Ariana employed Selena Smith, a production worker. Selena is required to work a 40-hour week, so that's a regular week, and is paid a rate of 200 per hour. Hours worked in excess, so they're talking overtime here. 40 hours are overtime and are paid at the rate of time and a half. So let us make a note of that one time. Overtime rate, the hourly rate, regular time is 200. And overtime is at time and a half. So you multiply by 1.5 and it's time and a half. So that will work out to be $300, yes? During the second week of April, Selena worked a total of 44 hours. So again, I like to make little notes. So 40 regular and 4 OT, meaning overtime. Right? Calculate Miss Smith's gross pay for the week. So we could say regular time or regular pay would be 40 hours multiplied by 200 per hour. Overtime pay, OT is overtime, right? 4 hours at 300 per hour. Right? This is how much? 40 by 200, 8,000. 4 by 300 is 1,200. $9,200. This is our gross pay for the week. For the month of April, Selena Smith earned a gross pay of $33,200. The following data is to be applied to her gross pay. National insurance deduction of 5%, income tax deduction of 10%, and a monthly credit union contribution of 300. Calculate Selena's net pay for the month. So, starting with gross pay. $33,200 less deductions. So we have national insurance. I like to write out all one time, right? Income tax and the credit union contribution. Do I working on the side here? How many am I working? So first one, national insurance. Doing 5% of 33,200 income tax. 10%. 10% at 33,200. So this is 1660. Put to 320. 33, 20, and 300. Adding up all those deductions. Again, here a total of 5,280. Net P. Easy, 3 marks. Complete the following. Check for the payment amount which is due to Selena at the end of April. So 30th of April, we will just use this here, right? 2026. Her name is Selena Smith. The sum of $27,900 and $20, no cents. 27920 dot. And just sign in signature there. All right, that's what our check would look like. And that's the end of this question. So you see, they went from a production budget straight into a payroll question. Yeah? All right, so we're looking at real manufacturing company. They say real manufacturing company, they manufacture automobile parts, model AF2. The following information is available for the direct cost used to manufacture one automobile AF2 part. We say the material requires 7 kgs of steel, both at a cost of $11 per kg. Right? The labor is 2 hours in the cutting department, 3 hours in the polishing department. All labor is paid at the rate of $15 per hour. Calculate the total direct cost of producing one AF2 automobile part. So everything here is direct cost, right? So our direct materials is going to be 7 kgs by $11 per kg. So that's $77, right? Direct labor is broken up into 2 departments. We have the cutting department and we have the polishing department. Cutting department, we're doing 2 hours by $15 per hour. So that's a total of 30. And here we're doing 3 hours by $15 per hour. That's a total of 45. So our total cost for producing one of these units, direct cost that is $152. Right? Simple as that. Calculate the total direct cost of producing 800 AF2 automobile parts. Right? So total direct cost for 800 units. The 800 multiplied by 152. As what? 121,600. Yeah? That's it. Mark and John. Mark and John are employed by Else Creation. So you're looking at another one, right? So that was it for this part of the question. If I remember correctly, this question went on to do a manufacturing account later on. I didn't include it here because we covered manufacturing accounts in a different section. Right? So I just wanted to look at the costing part of the question. Mark and John is another question here, and similar to one that we did earlier on, we're gonna have to complete a payroll form. So Mark and John are employed by L's Creation. They are paid $30 per hour for a basic 40-hour week. Work done in excess of 40 hours is paid at the rate of time and a half. So I like to write my overtime rate somewhere where I could see it. $30 by 1.5. $45 per hour is the overtime rate, right? During a given week, Mark worked 27 hours and John worked 46 hours. Calculate the gross pay for Mark. Mark would have been 27 by 30 as 810. And John worked 46 hours. So John working at 40 hours at $30 per hour plus 6 hours at $45 per hour. That's 1470. As rare marks to that, 3 marks to this, and 7 marks to this. Okay. The following additional information relates to the payment of Mark and John, Social Security calculated, and tax calculated and gross pay at a rate of 5%. Income tax deductions are calculated and taxable income at a rate of 10%. Using the answers from A above and additional information provided in the table, complete the payroll form which is provided as an insert. State one difference between statutory and voluntary deductions. All right, let's go. So gross pay I have here for Mark was $810, and for John was $1410. Social Security contributions are tax deductible, meaning that you do pay taxes on this amount, right? So you have to find 5% of your gross pay. 810 by 0.5, that's 40, 50 for Mark, and 1410 by 0.05, that's 70, 50 for John. So the taxable pay is 810 minus 40.5. That's 769.50. And for John, 1410 minus 70.5. That's 139.5. And you're paying income tax at a rate of 10%. So this is 76.95. And this will be 133.95. So net pay gonna be 810 minus 4050 minus the 76.95. This is going to be 692.55.
Excuse me,
Yeah. Right. So the 1470 we got because we divided this 46 hours that John worked into 40 regular hours and 6 overtime hours. So the 40 regular hours was by a rate of $30 per hour, and the 6 overtime hours was at a rate of $45 per hour, giving us a total of $14.70. Underneath here, the gross pay 810 and 1410. The Social Security was at 5% of our gross pay. And then the taxable pay was the difference between our gross pay. Yeah, go ahead.
On top is it's a 1470, right? By the bottom, it's a 1410. So like,
Oh, yeah. Thanks. Yeah, not 10, it's 70. So that we just had to change these say. Good eye. So 0.05 by 1470 was 73.50 here. And the gross pay would have been 1470 minus 73.5. This is our taxable income. Are we paying 10% of that? 139.65. Yeah, good there now? Yeah? All right, lovely. So 1470 minus the 73.50 minus the 139.65. I get in here now 1256.85. Yeah, we all right with that? Yeah, all right. And one difference between statutory and voluntary deductions. Statutory deductions are mandatory by law, and voluntary deductions, as the name implies, is up to the decision of the employee. They could agree or disagree to have those deductions. They want to cancel them, they could. Yeah, they have the option in choosing whether or not they want to include themselves in those deductions. All right.